Hi, folks. Brett Gerard, Portfolio Manager at Liberty, coming to you with another Liberty Market Update. This one for the month of February 2021. Let's go to the disclaimer before we get started. Please give this a read. Good. Okay, so this graph here shows the performance of the major stock indices that we track for the first 2 months of the year. And you can see that we started off the year continuing on a positive trend from Q4. And then by mid-month, in a way that's sort of reminiscent of the dot-com boom, there were rumblings on internet chat rooms about hot stocks. You might have heard this in the news. It was GameStop, it was AMC, it was BlackBerry. And the idea here was there's a number of hedge funds, big, large pools of money that had sort of bet against these companies and said, GameStop, it's a brick and mortar retailer. People aren't going into malls, and they're selling video games, which largely people are buying online. AMC, it's a movie theater chain. People are not going to be comfortable sitting in the movie theaters. And BlackBerry, just sort of a dying technology that doesn't really have anything on Android or Apple at this point. So the hedge funds, they thought that this was going to be a good opportunity to short these stocks and bet that the price would fall. Little did they know that the internet bloggers, in particular on Reddit, got together and they said, you know what, there's a big short position here and we can force these big hedge funds to buy back these stocks at higher prices. So there was sort of a mob mentality that got together and started pushing the prices of these arguably bad companies higher and higher and higher. And in doing so, we started to see a lift through the middle of the month. In January, through in particular the Nasdaq and the S&P, which are shown by the purple and the orange lines here. Now you probably knew this wasn't going to end well, and you can see there in the red circle by mid-month, GameStop, which went from sort of $18 up to $480, was back down to $50. And I'm sure there was some money made on the way up and probably some money made on the way down. But there's a lot of people that destroyed wealth in this process, in particular the Reddit bloggers. And if we ever needed another reminder to avoid the hype and invest based on fundamentals, well, GameStop and some of these other stocks are showing this in spades. And while the losses were contained to just these names, there was a little bit of concern floating in the media and out there that there might have been some contagion in pricing, in the sense that if a big hedge fund held GameStop and was suffering a loss, it might also hold Google or Amazon and have to sell that as well. Now, it turned out that there was enough liquidity in the market that wasn't the case, but that kind of caused the indices in general to move down towards the end of January. Moving forward, if we sort of fast forward into February, we can see that by mid-month, on the back of vaccinations in most places outside of Canada, investors were focused on the reopening and the anticipation that things were going to get better. That was partly short-lived, though, because as the realities of reopening are starting to set in, you can see the performance circled in the right side here of the markets did come off. And the reason why is, if people and businesses are resuming a semblance of normalcy, and if they're going out and they're spending like they were pre-COVID, then there's likely to be a surge in demand for goods and services. And if that demand's in excess of supply, think about people flocking back to restaurants or trying to hop on planes to get out of the cold, then we're likely going to see prices rise until we reach an equilibrium. And this phenomenon of rising prices is known as inflation. In our instance, the inflation will likely be accelerated by the fact that not everyone, but a material segment of the population, while stuck at home, has greatly reduced their discretionary spending. So if you have kids in hockey, you're saving $5 to $10 grand a year. If you can't go on a trip, you're saving another thousands of dollars. And all that money's adding up, and a lot of people are sitting on it and they're saving and saying, when things reopen, I'm going to go back and I'm going to do this or I'm going to do that I wasn't able to do in the last year. Now, this is obviously an unintended consequence by the governments because there were a lot of people that did need the funds, but nonetheless, there's a percentage of the population that does have money that does want to spend as we reopen. And that's going to lead to inflation. So, we have to link, though, this rising inflation to stock prices. And really, the threat of inflation is what caused stock prices towards the end of February to fall off. over the next bit, what we're actually going to do is we're going to have a multi-part video series that really dives into interest rates and the impacts of interest rates, both on stock prices and on bond prices, because they're very important, especially as we are sort of at historical lows in rates to the pricing of both these asset classes. But just a quick example to get started. In the past, when mortgage rates were falling, so, from sort of broadly the 1980s through to, really this year, if you had a 2% reduction in your interest rate, then your monthly payment would drop by about 25%. Now, this drop in payment meant that houses could be more affordable and consequently drove prices up, right? So that's a falling interest rate environment, and that has an increasing effect on asset prices. Now, if we flip that around and we say, because of inflation, we're expecting higher interest rates, and we'll delve into the linkage later, but if we expect that, then that same 2% movement in interest rates, instead of decreasing, we increase, then we're going to see a 25% increase in payments. Now, that's not really the environment that you'd expect house prices to be rising in. And that's potentially, what's on the horizon, both for house prices and for stocks. And really the reason is, if we just look at it from a high level, when you have low interest rates, it promotes borrowing. So what you do is, just like with the mortgage, you say, you know what, rates are really low, I can afford to borrow a lot of money. And when I do that, what I do is I pull forward demand, because the alternative is I just wait until I have enough money myself, and it might take me 5 years, and then I make the purchase of the home or the asset in 5 years. Instead, with low rates, I'm incentivized to go and buy right now. When rates rise, the opposite happens. And you look at your borrowing costs and you say, you know what, I might not want to buy right now. I might defer. And that deferral or the delaying or sometimes even the canceling of spending, that decreases demand outright. And so just a preview of the videos coming, this graph loosely shows you about interest rates. Here we're looking at the 10-year, which is sort of what you can expect if you're going to borrow money for 10 years, and beginning in January 2020. And so on the left-hand side of the chart, you can see the sharp drop from 1.88 down to 0.54. Now, this coincided with COVID spreading through the early part of 2020 and the result of the accommodative monetary policy stance that the Fed took. By March of the year, the 10-year traded at 0.54 and sort of bumbled along at historical lows through to the end of August, where you can see it actually hit 0.52. Now, from there until now, with the thought of reopening, it's been on a tear higher. And as you can see, we ended the month of February with the 10-year at 1.42. This doesn't sound like a lot, but it's almost 3 times the rate that it was 6 months ago. So there's a real concern out there that as we reopen, inflation and rising interest rates are just getting started, and that's going to have a material impact on stock prices. As we said, there's going to be a video series. We're going to try and delve into this fairly complicated topic in short, digestible videos so that you can understand the linkage between inflation, between rising interest rates, and between asset prices. So that's coming in the next couple of weeks, and we hope that you can stay tuned for that. In the meantime, as always, thank you for tuning in, and please reach out to your portfolio manager, either at their email or the email listed here if you have any questions. Stay safe and take care.